Welcome back to the Real Estate Standard Podcast. I'm Tim Kotzman. I'm here with Chris Drizga. This is episode 32, where commercial real estate and Bitcoin collide. Today is August 17th, 2026. Each episode, we endeavor to break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, Chris and I are going to dive into the state of the U.S. office market. Chris, Kenny's taken some time off to focus on the real estate operations over there. Before we get into it, any opening remarks?
Yeah, great to see you as always. Excited to dive into today's topic. It's near and dear to my heart, as I was telling you right before we hit record here. But yeah, we got a little bit of a new look and feel here. Kenny is going to be putting his time and effort into some other projects, and just had to step away from the weekly commitment. So no big deal there, and we wish him well and all of that. But that leaves you and I. We're gonna navigate and traverse this crazy space as best we can, live on air here. So we're just gonna rip the Band-Aid off and go with it. So any complaints, send them to the complaint department, and any kudos, put them in the comments.
Comment below.
Yeah, exactly. But yeah, this is like I said, today's topic is near and dear to my heart, just because in commercial real estate you specialize by property type. So obviously today we're going to be diving into office. That is the property type that I've spent my career really working in. Then you obviously have folks that specialize in all the other food groups, that is industrial and self-storage, retail, apartments, and there's healthcare. There's some specialty sectors there as well. But yeah, so I'm excited about it, and there's a lot of different narratives out there for the office sector, from people living and breathing it, all the way to the casual observer that still thinks remote work is 100% here to stay, and office is going to zero. There's every sentiment in between those two extremes. So I'm excited to get into really the halfway point of the year and share some statistics, trends, themes from the office market across the U.S.
Absolutely. Maybe we'll start zoomed out and get granular. How is the office market doing right now, especially what you're focused on? Is it recovering? Is it getting worse? Has it stopped getting worse? How would you characterize it? And then also, is it possible to simultaneously have too much office space and a shortage of good office space, again, simultaneously at the same time?
The short answer to that question is yes. The office market across the country, it's not a single market. It is incredibly bifurcated. It is incredibly geographic specific. And then once you kind of zero in on a particular geography or market, then it becomes very product specific. And, I think by and large, we can say that the market has or is entering a very selective but stabilization phase at that. You're seeing demand improving. You're seeing sublease space declining. Availabilities are declining. Positive absorption or we're posting positive absorption figures quarter over quarter. So there's a lot of the metrics that the real estate guys are looking and tracking. They have been improving over the last couple of quarters and even into throughout the first half of this year. So that is positive. Another thing that's really been big across the country is that there's effectively no new construction. in any pipeline. So you have new inventory essentially paused or at zero over the next 12 to 24 months. And on the supply side, you have a ton of obsolete inventory that is being removed from the marketplace. So you kind of have you have forces on both sides of that equation that are helping stabilize the markets, spur leasing and sales activity, and also maybe pad the data points, if you will, a little bit better than you would kind of expect them to be at this point.
Can you kind of walk us through who's actually leasing office space right now? Is there like one specific customer profile, or can you kind of pinpoint that, or how does that work?
Yeah. So I was using over the weekend, I was using my trusty AIs to kind of aggregate all these different major markets. And kind of looking at some of the major MSAs throughout the country, there are three clear leaders of office occupants. You got the government, you have law firms, and you have finance, real estate, insurance, professional services, if you will. Um, the one outlier there is in the San Francisco market. Tech is a huge market participant there, but in my market in Orange County, California, the law firms have been dominating the leasing activity. They're not just renewing their spaces, they are expanding their footprints. They are taking bigger, better space, and expanding their operations. So I think that's an interesting trend to watch over the next couple of years, because I think it flies in the face of the whole remote work, don't come into the office, don't commute, all of that. And the market has actually kind of done a complete 180 on that. The younger demographic, the younger professionals in the marketplace have said, we want to be in the office. We want to have that human to human interaction for a number of reasons, primarily just learning and mentorship and understanding how the business works. So that's been really encouraging. And again, you're kind of seeing some of those. You're seeing a lot of that being reflected in the market data here, with just the overall activity that law firms are, responsible for. Another big trend in the market across the country is this flight to quality narrative that you may have heard about. And basically, what that is the best performing assets in the market are in the highest demand. They are performing incredibly well. So over the last 5 years, as businesses have really figured out what their real estate needs are, they have generally reduced their footprints by about 20%. The majority of the operators have taken that square footage savings and they've used it to access nicer buildings, right? Maybe they were paying, they're willing to pay 10, 20% more on the base rent, knowing that they reduce their overall footprint. And that is a national theme that's happening across every MSA in the country. Again, where the trophy assets are performing incredibly well. There's actually a shortage of high quality office space. So if you're a business and you're exploring the market, you come to find out pretty quickly that there aren't as many bargains as you may have thought in the marketplace if you're looking at that class, A plus type of product. If you're looking into the A minus or B commodity type of office, there's options galore. It's kind of hard to really sort through them. So the flight to quality has been a big theme across, again, every market in the country, and I would expect it to continue to play out that way.
Can you walk us through the term controlled demolition that I think you've used, and what exactly does controlled demolition mean, and how does that kind of describe what's happening in office a little bit?
Yeah, controlled demolition. I started using that phrase a few years ago. I was watching the very beginning phases of this recalibration take place, and I'm like, I was expecting to see kind of the headline data points print much higher numbers, right? I was waiting for vacancies to be 30, 40%. I was waiting for rents to plummet. It just never materialized. The distress never materialized at the scale I expected it to. And as a broker in the marketplace myself, you can see it, you could feel it, that there weren't as many options, like quality options to go tour, or to go show clients, to buy, to sell. Um, so I was just trying to reconcile those two things, and I came up with controlled demolition because when you look across the country, there has been significant removal of that obsolete office space, right? The older product that was, again, commodity space, maybe it was classified as B properties, even A minus properties. They've been demoed, they've been converted, they've been acquired by owner operators. So that square footage gets removed from the supply, which in turn props up vacancy figures and absorption figures, rent figures. Um, and I mean, in my market here in Orange County, we're a small deal market. We have about 100 million square feet of inventory for office. Over the last 5 years, we've removed just over 6 million of that supply. So 6% was removed from the inventory base, and you're sitting here at about a 14% vacancy rate. You compare that to the 0809 crisis, the GFC. Our vacancy was in the low 20s at that point. So you kind of just put those two side by side, and if you didn't have that obsolete inventory get demolished or converted, you're right back there, right? You're in that low 20 percentile range pretty quickly. So with the removal of the obsolete inventory, there were businesses in those buildings, right? They may have been well leased. They could have had some vacancy, but there were businesses in those buildings, by and large, and those operators were forced out into the marketplace to go find new homes. So they were they were competing with everyone else. So as the amount of space became less and less. So that's what I mean by controlled demolition, was that it didn't happen all at once. It was a slow process, but you start to look backwards at some of the activity the last few years, and there was a steady removal, about 1 million square feet of space in my market consistently every single year. And there's even more on the chopping block for the next 2, 3 years as well. So, you fast forward this to end of 27, early 2028, we have this conversation again. There's a good chance I'm going to be telling you that we're close to that 10 million figure of footage being removed from just our market in itself. I was looking through, on this topic of controlled demolition, I was looking through some of the market reports that I pulled, and Cushman and Wakefield had 33 million square feet removed over the last 5 quarters. Right, that's just over a year. 33 million square feet. That's a lot of space. JLL had 25 million square feet removed over pretty much the 2023 peak of the inventory peak in 2023. Avis and Young has a figure out there that inventory has contracted by 80% since of tracked markets since 2024. So again, I'm an expert in Orange County, California. I'm relying heavily on these reports for the rest of the country, but I think the takeaway and the narratives, the key theme and trends are very consistent when you look at it from this standpoint.
At what point does distress become opportunity? I mean, kind of reminds me of when you have a preferred stock that, you know, ideally trades around $100 and it goes down to 90 or 80 or 70. And at a certain point, if you have if your thesis is that it's going to go back to 100 at a certain point, you're like, oh, I'm probably going to buy it here. And whether I hold it long term or not, just collect that 10, 20, 30% spread. So like, are we approaching that point, or like, is there a certain number where you see opportunists enter the market?
I really appreciate that comparison, but it's not, you're not playing the same ball game. It is very, very different. And, you know, when it comes to the distress being, turning into opportunity, I think, and we've talked about it on this show many times, but we're doing now in this phase of the cycle is we're getting back to the basics. We're getting back to where the real high quality operators are separating themselves from the marketplace. In the last couple of cycles, it was, you could largely buy something, let the market do its thing, let inflation do its thing, hold on to it, and you could get out of it, right? And say made a profit. I think those days are gone. And when you look at some of these distressed opportunities today, you need to scrutinize the real estate and the local market harder than ever before, especially in office space. Just because you can get an office building for pennies on the dollar does not mean it is a good deal or it's a good idea to pursue that. I think location is playing a more important role than it has in the last handful of years. If you do not have a good location with good access to amenities, good access to transportation and just overall mobility, the thing's going to struggle, like full stop. And you're seeing it in a lot of the data with this flight to quality. The one of the things that all these trophy assets have in common is that they're like this campus style environment, right? When you get to that property, you really don't have to leave. You have your food, you have some retail, you have service options, by the way, you're working, so companies are using it at their office space more than just a place to work. They're using it as a way to recruit and retain talent, right? If you're sitting there spending 8, 10 hours of your day at the office building, people want to enjoy where they work, right? They don't mind commuting that 30 minutes, hour, whatever it is, if they have a nice environment to, do it in. But getting back to your original question, location is more important than ever. And I think you have to scrutinize the functional obsolescence of the buildings more than ever before too, because the cost to re-tenant these buildings, the cost to renovate them is absolutely through the roof. It is incredibly cost prohibitive to re-tenant an office building these days. So if you cannot justify the capital expenditure through rental growth and a stable occupancy, again, you're going to struggle. We've talked about it on the show many times before, but this is where having a Bitcoin treasury, having a Bitcoin strategy becomes incredibly, incredibly helpful. I would probably make the argument that office property is the most capital intensive of all the property types in CRE. To re-tenant a vacancy in an office building could easily exceed $100 a square foot, depending on the condition of the space and what you're trying to do. That $100 a square foot is on top of carry costs and marketing fees and transaction fees. So by the time you're all said and done, the cost to originate a new lease could be 20 to 25% of that total lease value. right? And again, that's an upfront cost that the landlord has to put out. So you come back to, the theme of our show, viewing real estate through the lens of Bitcoin. If you're operating solely in US dollars, that dog doesn't hunt, right? Like you cannot keep up with the marketplace. So you need to have other mechanisms, other strategies, other assets that can help you offset that rate of, I don't want to say growth, but that rate of debasement. So it's going to, anyway, that was a really long-winded tangent, I suppose, but it is going to be exceptionally more difficult to succeed in office. Do I think office goes to zero? Absolutely not. We were overbuilt going into 2020. We're finally seeing a lot of that overbuilt, obsolete supply be removed, and we still have a long way to go. As evidenced by some of the data points we were talking about earlier. So it's going to take, probably another 24, 36 months to really see where the office market stabilizes at.
So you're talking about the next 24, 36 months. If you were a tenant right now in Orange County with a lease expiring in 12 or 24 months, what do you think they should be thinking about right now, doing right now, being thoughtful about right now?
Yeah, great question. It's a great time to be a tenant. That I'm excited to tell you that it's a great time to be a tenant, great time to be a business owner, and that has not been the case for a handful of years. It was a one direction market for over a decade. So to be a business owner, to be a tenant, and have some not only relief but also negotiating leverage is a welcome change of pace. Um, so the timeline that you're talking about is really dependent on how big or how complex your space needs are. Generally, if you're, call it an operator, you're a law firm, for example, a financial services firm, you need 10,000 square feet. Someone like me is going to tell you, you need to be exploring that. You need to be in active negotiations and looking at spaces 12 months in advance, right? That's the the minimum. So that's a way of saying that time is your biggest asset when you are a business owner and you're looking for space. Whether you're looking to lease, maybe you're renewing a lease, maybe you want to relocate the business altogether, and participate in that flight to quality. Maybe you're looking at saying, "Hey, I'm done paying someone else's mortgage. I want to go own my own property." Same thing. So the larger the requirement, the more time you have to give yourself, because not only do you have it helps with the negotiation leverage, but there are there are things in the process that are out of your control. For example, tenant improvements. Every city is different, but generally the tenant improvements are the bottleneck in the entire process. So again, varies based off where you're at, but in my market, just to get your permits and plans approved and be able to start swinging hammers, it's a 6 to 8 week process if everything goes smoothly, right? So, that eats up 60 days right there, 2 months of your, 12-month process right there. And again, your build out process there, your construction process is probably 16 to 20 weeks at that point. So you can see how those timelines get condensed. They get eaten up really, really quickly. So tenants, one, get a broker that's local. I know that's might sound a little self-serving, but get a broker in your local market that specializes in office space, and start the process as early as you possibly can. I'd rather you be too early and landlords tell you, "Hey, we're not entertaining this conversation just yet. Come back in 90 days," than to be late to the game.
Makes sense. Be proactive.
Yes, very proactive.
Um, would you say that tenants could maybe think about targeting distressed buildings because they can presumably get better deals, or is that not necessarily the case? Is the juice worth the squeeze on that one?
I think that's a great way to put it. And assessing whether the juice is worth that squeeze is the $1 million question. For the longest time, again, we had a one-way market for over a decade, and landlords had their pick of kind of the litter, so to speak. And landlords would scrutinize tenants' financials, your business financial statements, and that was just part of the process. Today, in today's market, especially if you're looking at an office asset that is, distressed, there could be some unnecessary or unwanted risk there just because of the instability that a financially weak landlord brings to the table. Um, so it's a case by case situation. If you are a larger operator, if you have the experience, the resources, or even the sophistication to kind of understand what you're getting into, then sure, maybe a distress situation makes more sense, because there's a lot more you can control, as far as the outcomes concerned there. But for the majority of the market, call it 90% of the marketplace, I would say that's not worth the headache. You are probably better off focusing on stable, high quality, established landlords and buildings, because y- you don't have to worry about, or you have to worry less about the what ifs. What if these guys go out of business? What if the keys get handed back to the bank? Who's the new operator? Where's the disruption coming from? Are they going to make good on the capital improvements that they sold us on when we were touring the building, right before we even signed a lease? There's a lot of questions that come up, that, frankly, if you're a business owner focusing on your business, maybe you operate a media company, you need to focus on that media company, right? You don't need to worry about the landlord and, are they going to complete your tenant improvements? So, just again, I think there's definitely opportunities or areas where that makes sense, but as a rule of thumb, I'd probably say, don't go looking for the project.
How would you think about how an owner would know whether they should keep putting capital into their building, or at what point it becomes like throwing
Good money after bad.
bad money after good money, however you want to look at it?
Yeah, and before I answer that, just one last thing on that prior question. If you're a tenant, a business owner, make sure that you are evaluating the landlord's financials. Make sure you understand who the landlord is that you're partnering with. What is their capital structure? What is their corporate structure? Who are they? Where's their money come from? What does their portfolio in that market look like? Is it 90% leased, or is it 60% leased? Those are two very different situations. So to be able to not only understand that, but also use it as a negotiation point, and also use it as part of the decision making process, is going to come in very handy when it all ultimately concludes. So, and have your broker request the landlord's financials. That's where I was going with that. I got sidetracked there, but that's where I was going with one of those first comments there. It was a one-way street, landlord scrutinizing tenant financials. Guess what? Now the tenants get to do the same back to the landlord. So utilize it. Remind me of the question, the follow-up question there, too.
Should owners keep throwing money into their building, or when's the point of diminishing returns, or bad
Yeah.
money after good money, as far as just continuing to put capital into their building? And maybe there's different aspects to that, right? Like preventative maintenance versus repairs, and I should probably take care of this right now, versus actually improving it, versus waiting for a tenant to come along and improve it, etc.
Yeah, that's a great question. And, I don't have a silver bullet for you on that. It's very property specific and market specific. But I think it goes back to what we were saying at the top of the hour here is you need to understand where your building sits in the market. Is it in that A bucket? Is it an A building that can compete? Yes or no? If the answer is yes, then I would explore further efforts, right? What is your market? What's the market? If it's an A building, what's the vacancy in that market, right? LA right now is north of 30%, right? That's a lot of space. So there's a lot of A buildings in LA that, you know, don't have a snowball's chance in hell. But if you're in Orange County, which is only 30 minutes south of LA County, you got an A building. Our A building vacancy is 12% and change, right? There's an operator. They're one of the largest private commercial real estate operators in the country. They're called the Irvine Company. Their office portfolio is 3% vacant, just in Orange County. Like it's a dogfight to get space in their buildings because they are the best ones in the marketplace. Everybody wants to be there. So you need to understand where your building sits in the marketplace. Is it, garden style B building? Is it a class A office tower? And, who are you serving in that marketplace? The other question, or the other component that you brought up there that's really incredibly important is, do I just have some basic deferred maintenance that I need to keep up with? Or do I have to roll out a comprehensive capital improvement plan? Right? Do I need to go spend 7 figures renovating the building to get the rents and the tenants that I want? I would, just off the cuff, I would probably err on the side of don't do that in most office situations. But again, it's a case by case situation ultimately. Yeah, another way to look at it is what is the underlying zoning? What's around you? What signals has the municipality that you're operating in put out there? Are they pro redevelopment or not? Right? I mean, maybe there's an exit for you in the form of redevelopment, right? There's you own an office building, maybe there's a multifamily residential play to it, right? Where you can get out of the asset with some, skin intact, essentially, right? And you don't have to put up all that upfront capital that we're talking about here to, to get out of it and save your rear end. So there's a lot of different ways to look at that. I think the residential conversion conversation has really stolen the spotlight, but there's a lot of really interesting conversion plays. I think that you're going to continue to see just pick up steam. Office to resi has been one. Office to industrial has been one. Office to data center, I think, would be an interesting one. White box, all of the floors, pull in the power and just run a bunch of servers in there, right? Is it a 100 megawatt center that's leasing to OpenAI? No, but it's going to serve the local market on its basic needs. So it'll help serve a segment of the market. There's some interesting plays there. So it's a case by case.
And for those playing along at home, you may want to rewind because Chris did say 6-7 in his last answer. Are there any office market related headlines that you're seeing right now that you think most investors are getting totally wrong? And I don't know, maybe that means the headline's wrong, or somehow the market's picking up on a signal that's becoming a headline and you're like, no, that's not actually what's going on.
Yeah, that's an interesting question. Specific headlines to point to, I don't know that I have a specific headline. or a specific article, but one that comes to mind is the move away from financial engineering and a move into operational excellence. The importance of being a good operator. We touched on that at the beginning of the episode today, but that's a big theme that's taken place. I think the folks that are in the industry, living and breathing it every day, if they don't know that explicitly, they can feel it. It's coming. We're in the very beginning innings of that transition. We've seen some really, really, really high profile, distress situations, syndicators basically telling their LPs, there's going to be no return of capital and we're closing up shop. I think those are, the first phase of, many. So the refocusing on what it means to be a really good operator is a major headline, a major trend that is only going to pick up speed. And what does that mean? That comes back to knowing your real estate better than the next guy. That means creating operational efficiencies. That means integrating technology and AI. Having a Bitcoin strategy. That's a big one that we talk about here, obviously, and having an energy strategy as well. I think the future operators the excellent operators, they're going to be able to integrate and execute on the real estate, on the Bitcoin, on the technology, and on the energy across every asset at a very high level. They're going to be able to create strategic reserves that help them get through the cyclical challenges that the asset class has. They're going to be able to reduce expenses in a very creative way. They're going to be able to create new income streams that were never thought of before. And those operators they're going to outcompete the market in a very big way. It may take a few years for the market to recognize or catch up with it, but it's going to get to a point where the financial results speak for themselves, and people aren't going to be able to ignore it. So that one's a big one. Another one, I forget, Michael Levy, the CEO of Trammell Crow company, a major developer. They're based out of Texas. He put it really, really nicely on a recent podcast I was listening to him on, but which basically what he said was the real estate industry is over mature, right? And on top of that, there is massive consolidation taking place, right? That resonated with me a lot because I felt like he was saying the same thing that we've been pounding our fists on the table here on, but coming at it from a more, maybe traditional real estate sense, or a more, I don't know, more buttoned up way of approaching it. But when you look at the maturity of the space and all the consolidation taking place in it, who owns those mature assets, right? Where they're having a hard time getting rent growth. They're battling increasing expenses. They're not getting the cap rate compression that they need. It's Main Street, right? It's not your institutional owners. It's not your REITs that own that stuff. It's you and me and mom and dad and the guy down the street. This is what we have been talking about at length on this show over the last 6 months, is being able to have the importance of having an objective conversation with yourself and your partners about what you own, right? And what's worth holding on to versus what's not, right? And if you are looking at a dozen properties in a portfolio, you need to designate those that are worth holding on to and pouring into, and those that are not. And I think that's what Michael Levy was really getting at, was that latter category, right? What do we just need to cut loose?
I guess
did I answer your question, or did I just ramble?
I'm trying to figure out based on your last answer, if all of that is leaning towards a cyclical recovery, or whether the office market is kind of like permanently restructuring itself, or if you disagree with both of those options.
No, not at all. I think just like we had a prolonged bull market or a prolonged cycle, I should say, all the way up to 2020, I think we're going to have a prolonged down cycle, right? I would not be surprised if the entire 2020 decade is a, if you want to call it a recession or just a down market. It would not surprise me if it takes 10 years to fully filter all of this through. On the back side of it, when we look at it, will there have been structural changes? Yes, absolutely. Absolutely. This is a structural shift. It's a structural cycle that is taking place. And it's how capital is being allocated. It's how tenants and businesses are approaching their real estate. It's how consumers are experiencing real estate. It's how we finance real estate. You look at commercial real estate from a financial standpoint. You look at CRE and the returns it's produced over the last decade. It's been dismal, right? It's at the bottom of at the docket when you compare it against the major alternatives, right? Whether it's equities or private equity, the S&P. I mean, pick your kind of your favorite food groups there. It has underperformed to a very large extent. So I think it's going to take folks that, again, really have an angle or an edge in where they're operating, what they're doing, and they have the conviction to execute a strategy, a comprehensive strategy. And that goes back to what, we talk about here every week: real estate, energy, technology, Bitcoin. How do they all come together to create a resilient property?
Got it. Last but not least, before we wrap up, when all of this kind of shakes out over the next couple of years, do you think the office market that finally emerges is actually going to be healthier than the one we had in 2019, or not?
Yeah, absolutely. I mean, that's the point of this entire process here is, we're out with the old, in with the new. There was a lot of malinvestment that needed to get flushed out. There was a lot of obsolete inventory that needed to get flushed out, and we're in the thick of that. That is happening, again, as we talked about here today. That is happening across the country in every market that we track. So, and again, commercial real estate does not move at the pace that Bitcoin does. It does not move at the pace of AI or the stock market, or even your favorite financial news headline. We move at glacial pace. So it's going to take a lot longer for these structural changes to really flush through the market, and for the market to recalibrate and make its way up the next side of the curve there.
Got it. Any final thoughts before we wrap episode 32?
Final thoughts. I thank you for bearing with me here today. I know you're the Bitcoin Treasuries guru. I took you on a little journey here into the deep commercial real estate world, but I think we did a good job. I think we kept our head above water. Closing thoughts. I was thinking about today, the office market is the redheaded stepchild of the commercial real estate world. And this kind of goes to your last question too. When we come out the other side, it's going to be a lot more resilient. It's going to be stronger. It's going to be better off. It was not too long ago that retail was the redheaded stepchild, right? Going through the 2010s, retail was getting beat up from every which way because of Amazon, right? Retail's dead. Retail's going to zero. No one goes to the retail center. Well, guess what? 10 years later, retail is arguably the best performing property type in all of CRE, right? So that goes to kind of the cyclical point we were talking about, or your cyclical question. Um, it's just we're going to flush all this out, and the sector is going to be better off for it. And who or what is going to be the next redheaded stepchild? That's a good question. Um, I need to, maybe we'll come back to that next week, and I'll have an answer for you there. But I think, gun to my head, I'd probably say the multifamily space is next on the chopping block for that title. But we'll see.
All right. Come back next week for the redheaded stepchild episode 33. But that's it for today's episode. If this conversation was useful, please share it with a partner, a client, somebody making real decisions in the marketplace. New episodes of the Real Estate Standard drop weekly. So until next time, stay disciplined, think long term, and stack sats. For Chris Drizga and myself, this is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market. You can find our contact information